My name is Tanny Allen. I'm the MLA for Fort McMurray Wood Buffalo and chair of this committee. I'd like to invite members, guests, and staff at the table and introduce themselves for the record, and we shall begin to my right.
Hi, it's Garth Rosewell, MLA, Vermilion, Lloydminster, Wainwright.
Morning, everyone. Eric Bouchard from Calgary Lougheed.
Good morning, Grant Hunter from Cable Warner.
Good morning, Andrew Bachenko, tradesman, Valley Devon.
Good morning, Ron Weed, Grand Prairie Wapiti.
Good morning, Jean-David Tremblay-Frenette from INCO.
Good morning, Paul Angel from INCO.
Good morning, Amit Prakash from INCO.
Hello, I'm Steve Thompson from Treasury Board of Finance.
Good morning, Brittany Jones, Treasury Board of Finance.
Good morning, Lowell Lett, Treasury Board of Finance.
Good morning, Surinder Brown, Calgary.
Good morning, Mayor Christina Gray, MLA for Edmonton Middlewoods.
Good morning, Samir Kayanda, Calgary.
I'm Pat Kozowski from Sherwood Park.
Good morning, Christina Steenbergen, LAO Communications.
Good morning, Rhonda Swenson, Manager of the Communications Services.
Good morning, everyone. I'm Travis McCoy from the Parliamentary Council Office.
Good morning, everyone. Nancy Robert, Clerk of Journals and Committees.
Good morning, Warren Huffman, Committee Clerk.
Thank you, everybody, so much for that. Before we move on with our meeting today, we should address participation via teleconferencing and video conferencing for meetings of the committee. Section 6 of the Legislative Assembly Act permits members to participate in a meeting of a committee of the assembly by means of telephone or other communication facilities that permit all members participating in the meeting to hear each other if all of the members of the committee consent. So, committee rooms here in QE2 building are equipped to facilitate meeting participation via teleconference and video conference. And committees do have the option of passing a motion, which must be agreed to unanimously, to approve meeting attendance via teleconference and video conference for the duration of the legislature or for a particular meeting or series of meetings. Passing such a motion for the duration of the legislature does not preclude the committee from requiring that members attend specific meetings in person. In those cases, a motion would be moved at a previous meeting requesting that all members attend that specific meeting in person. The wording of the potential motion to allow this participation for the duration of the 31st legislature was posted on the committee's internal website. If someone would like to move that motion, we can display it in the room and debate it. Otherwise, other motions can be brought forward. And with that, I'm going to open the floor to those in the room for some discussion.
Should I move the motion, or?
Just going to put it up on the screen here.
Okay, fair enough.
In which case, yes.
Okay. Okay, I'll read it up. I'd like to move that the Standing Committee on the Alberta Heritage Savings Trust Fund consent for the purpose of Section 6 of the Legislative Assembly Act to remote participation by any member in the committee's meetings held at a designated committee meeting room in the Queen Elizabeth II building during the 31st legislature, unless the committee carries a motion in advance of a meeting that remote participation of members is not permitted at that meeting.
And with that, does anyone have any discussion over this statement, or if that's the case, then does anyone disagree with this motion? Perfect. With that, I say that this is made. We can now do. Oh, okay. All right. Let's do the official one. With that, can I get all in favor of?
Aye.
Aye. All opposed? Carried. And with that decision made, we can now do introductions for those joining us via the teleconference and video conference. As I call your names, please introduce yourselves. So with that, we do have one. Mr. Nelson Robe from.
Good morning, Nelson Roby from the Office of the Auditor General.
Thank you so much for that, sir. And we have no substitutions today. Now, we do have a lot of housekeeping, seeing as this is our first meeting, so bear with me. First, note that the microphones are operated by the Hansard staff. Committee proceedings are live streamed on the internet, broadcast on Alberta Assembly TV. The audio and video stream and transcripts of meetings can be accessed via the Legislative Assembly website. Those participating by video conference are encouraged to please turn on your camera while speaking and mute your microphone when not speaking. Members participating remotely who wish to be Those participating by video conference encouraged to please turn on your camera while speaking, mute your microphone when not speaking. Members participating remotely who wish to be placed on the speakers list are asked to message the committee clerk, and those in the room should signal the chair or committee clerk. Please set your cell phones and other devices to silent for the duration of the meeting. Draft agenda for today's meeting was made available to all members. Does anyone have any changes or additions to the draft agenda? If not, would someone like to move a motion to approve the agenda? Mr. Weeb. All in favor?
Aye.
Anyone opposed? Thank you very much. Carried. I'm supposed to do this.
No, that's fine, that's fine.
All right, so as this is our first meeting, I'd like to provide members with a little bit of information about the committee, its mandate, and the meeting procedures. The mandate of this committee is found in section 6(4) of the Alberta Heritage Savings Trust Fund Act. A link to the act can be found on the committee's internal website. In accordance with section 6(4) of the act, the committee's primary functions are to receive the fund's quarterly reports, approve the annual report, and review the overall performance of the fund. Additionally, the act requires that the committee hold public meetings with Albertans. This has traditionally taken the form of an annual meeting during which members of the public are invited to pose questions about the fund in person, over the phone, and through email and social media. We will discuss these more in detail in item 7 of the agenda. Meeting schedule. The Heritage Fund's quarterly and annual reports become available in February, June, August, and November. And the committee meets shortly afterwards to review them. The committee also has its annual meeting with the public near the end of the calendar year. Members are called at the discretion of the chair. When possible, the chair will poll committee members for their availability when choosing a date and time. Once a date and time are set, the meeting notice is mailed to members and other relevant parties. The draft agenda, meeting minutes, and any briefing materials are made available to members on the committee's internal website prior to the meeting. During meetings, the chair maintains a list of members who indicate that they wish to speak, and an effort is made to ensure that all members have an equal opportunity to participate in discussions and ask questions. For questions which may require more detailed response, members may read the question into the record and request that a written follow-up response be provided to the committee. To minimize interruptions during proceedings, I'd also ask that members participating remotely through teleconferencing and video conferencing send a message or email to the committee clerk if they wish to be added to the speakers list during discussion on a particular item of business. After the chair has conducted a vote, known as the voice vote on a motion and has announced whether the motion is carried or defeated, a member may request a recorded vote. The process for conducting a recorded vote has been modified a bit since the last legislature to more closely follow how divisions are conducted in the assembly. The chair will ask all members in the room in favor of a motion to raise their hand, and the committee clerk will state their name and record their vote. Those in the room opposed to the motion will then be asked to raise their hand for the committee clerk to state their name and record their vote. The chair then asks those participating via video conference who wish to vote to turn on their camera. The committee clerk calls the names of those with their cameras on to state their vote and then records it. The chair will then ask any members who have not voted and wish to do so to state their name and vote. Anyone teleconferencing should vote at this time. And finally, the committee clerk tallies the vote, reports the totals for and against the motion to the chair, who declares whether the motion was carried or defeated. And please note, in accordance with Standing Order 32.5, members may abstain from voting. A member who may be unavailable for a meeting of the committee may designate another member who is not on the committee to substitute for them. Standing Order 56.2.1 outlines the process for a substitution of committee members. 56.2.1, temporary substitution of the membership of a standing or special committee may be made upon written notification signed by the original member and filed with the clerk and the committee chair, and through an email communication sent directly from the original member to the clerk and committee chair, provided such notice is given on a business day, not less than 24 hours prior to the meeting for the substitution of a chair or deputy chair, and prior to the scheduled start of the meeting for the substitution of any other member. An email substitution template is available through our house, and the committee clerk can provide a template upon request. The substitution form must be sent from the committee member's own legislative assembly email account address. Alternatively, the member may submit a letter that they have signed to provide notification of the substitution. A staff member or another member cannot authorize a temporary substitution on behalf of the committee member. When substitutions occur, it is the responsibility of the original committee member to ensure the committee has been provided with all the necessary meeting material. Any member of the Legislative Assembly who is not a committee member or official substitute may attend and participate in committee meetings, but they may not move motions or vote. The committee relies on the technical expertise of officials from the Ministry of Treasury Board and Finance and the Alberta Investment Management Corporation in its review of the Heritage Fund. The TBF officials administer the fund and produce a quarterly and annual report that the committee is charged with reviewing, and AIMCO is responsible for the day-to-day investment decisions of the fund. Officials from the TBF and AIMCO will have the opportunity to go into more detail regarding their roles under the next item of business. Legislative Assembly office staff from the Parliamentary Council, Research and Committee Services and Communication Services support the committee to conduct roles and prepare for the annual public meeting. I'd like to give a brief overview of their roles in relation to the committee. Parliamentary Council is available to assist the committee if it requires legal advice. We have the Communication Services, which provides the committee with communication support, particularly related to the annual public meeting, which we'll discuss later this morning. Research Services can provide the committee with research support if necessary, and the committee clerk provides general administrative and procedural support and is the primary point of contact for the committee. So if you have any questions, please reach out to him. The committee has also provided support from the Auditor General and his staff. The Auditor General is the independent auditor of the Heritage Fund that reviews the fund's financial statements and supports the committee during meetings. I'd invite the OAG staff to please play the role of the Auditor General with respect to the Heritage Fund and this committee. Mr. Nelson Robe-From.
Good morning. Thank you very much. So the mandate of the Office of the Auditor General in relation to the fund is twofold. Firstly, to provide an audit opinion on the fair presentation of the annual financial statements of the fund in accordance with public sector accounting standards. And secondly, our office also has a performance audit mandate to examine the economy, efficiency, and effectiveness of government programs and processes to provide assurance they are working as intended.
Well, thank you for that, sir. We'll now move on to the Fund's 2022-23 annual report. The Fund's annual report. Sorry. That's great.
Thank you, Mr. Chair. I just wanted to ask a question on the committee orientation information you've shared with us. And understanding that the quarterly report and the annual report have been prepared for us and have been waiting since June, I realized that this meeting needed to happen as quickly as possible. I noted you said that when possible you will be polling for potential meeting dates, and I just was hoping to have a commitment from you that in the future we would be polling for suitable dates for all members. Because this one was very short notice, and yeah, just wanted to test on that point if you wouldn't mind.
Agreed, Ms. Gray. So for everyone's record, just the timing of the election combined with a few other factors led to some reports being overdue in their on the public record. So we need to have this committee, the members weren't even appointed at that time. So we're now playing catch up. So we'll be going through two reports this today, and we'll definitely for future we will certainly poll all members to make sure there's a mutually agreeable time and place, especially for the House Leader of Her Majesty's official opposition, to ensure that her team is prepared as well.
Thank you.
Absolutely. So the Fund's 22-23 annual report. The Fund's annual report is prepared by the Treasury Board of Finance, and as stated in the Alberta Heritage Savings Trust Fund Act, must be reviewed and approved by the committee and then furnished to all members and the clerk of the Assembly before it can be released publicly. The report was posted to the committee's internal website for members to review. We are pleased to have officials from the Treasury Board of Finance and AIMCO here to assist us with our review. I'd like to turn it over for them to first make some opening remarks about their roles with the fund and the committee, and then ask them to speak about the annual report. Please.
Thank you, Mr. Chair. Good morning, committee members, honored guests. My colleagues and I are here to represent the Department of Treasury Board of Finance. My name is Steve Thompson. I'm the Executive Director of Capital Markets. I'm joined by Lola, the Assistant Deputy Minister of Treasury and Risk Management, and Ms. Brittany Jones, who is our Senior Manager of Portfolio Analytics and Research. As you are aware, the Heritage Fund operates under the authority of the Alberta Heritage Savings Trust Fund Act, which states in part that the mission of the Heritage Fund is to provide prudent stewardship from the savings from Alberta's non-renewable resources by providing the greatest financial returns on those savings for current and future generations of Albertans. Section 3 of the Act requires that investments of the Heritage Fund must be made with the objective of maximizing long-term financial returns. This section of the Act also requires that the appropriate steps are taken to balance the risk and return such that the fund may obtain sufficient investment return to enable it to meet its objectives. To help achieve these stated objectives, the Department of Treasury Board and Finance is tasked with supporting the Minister in the development of the fund's long-term investment strategy and in providing ongoing operational support services, which include research and analytics into investment policy improvements, the monitoring of investment performance, preparation of annual and quarterly reports for the fund, and producing an income forecast for the fund. The department is responsible for developing and maintaining the statement of investment policies and goals to provide guidance to the Heritage Fund's asset manager, Inc., who execute the required investment management functions on our behalf. TBF also has a responsibility for advising the Minister when changes to the investment policy may be required to enable the fund to continue to meet its stated objectives. The policy may be reviewed and revised at any time, but the department must formally review the policy at least once every calendar year. Significant events that may prompt a review include a fundamental change in the requirements and objectives of the Heritage Fund, significant revisions to the expected long-term trade-off between risk and reward on key asset classes, a significant change in the financial risk tolerance of the province, shortcomings of the investment policy that emerge in its practical application, and changes in any applicable legislation. INCO is consulted on material changes to policy prior to these changes being recommended to the Minister, as they are responsible for executing the investment management functions required to implement the policy. With that introduction, I'm pleased to present the annual report of the 22-23 fiscal year results for the Alberta Heritage Savings Trust Fund. As previously stated, the legislative objective of the Heritage Fund is to maximize long-term financial returns while balancing the risk of losses. In 22-23, the Alberta Heritage Savings Trust Fund realized a return of 2.6% over the fiscal year and grew by $2.5 billion from the previous year's market value to a market value of $21.2 billion. The Heritage Fund's growth in the fiscal year 22-23 was primarily driven by government action rather than by investment returns. Legislative changes were enacted that allowed the Heritage Fund to retain $1.25 billion in investment income in the 2021-22 fiscal year. The strong fiscal results allowed government to make a one-time deposit of $753 million into the fund, the first such action since 2008. The fund's remaining growth came from a $626 million increase in unrealized gains, offset by $114 million in investment losses. The fund generated gross earnings of $20 million, resulting in a net loss of $114 million after investment expenses of $134 million were taken into consideration. This is only the third time that the Heritage Fund reported a net investment loss since its inception in 1976. Net investment earnings were $1.9 billion lower than estimated in budget 2022. The primary driver of this performance were the challenges faced by global financial markets during the first half of the fiscal year. After inflation proofing, there was no investment income available to be transferred to the General Revenue Fund during the fiscal year. Again, this has not occurred since the global financial crisis in 2008. The investment strategy for the Heritage Fund is established with a long-term view. The focus continues to be on maximizing long-term returns and not overreacting to short-term events. Measuring performance over the longer term captures changes in the economic cycle and provides broader perspective. The fund has a target return of the Canadian Consumer Price Index plus 450 basis points measured over a 5-year rolling period. The target return over the period is 6.7%. This target has been steadily increasing as inflation persists. Over 5 years, the fund returned 6.4%, which is 30 basis points lower than its CPI target return. Over the last 10 years, the Heritage Fund has earned an average annual return of 8.4%. The fund also has a target return to help determine the investment manager's ability to add value through the active management of investments. The target is that the return of the Heritage Fund should be at least 1% higher than the returns of a passively managed portfolio. Over 5 years, the manager has delivered an active return of 40 basis points above the passive benchmark. Despite the macroeconomic challenges and negative returns recorded in the first half of the year, the fund's 2.6% return for fiscal 22-23 did outperform its passive benchmark by 1.2%. Rising interest rates in Canada and in most other global markets had outsized influence on markets and investment returns during the year. Rate increases had the most significant impact on the publicly traded assets held within the equities and fixed income asset classes. A decline in equities and fixed income in concert and of this magnitude has not been witnessed in the past 40 years. The Heritage Fund did benefit, however, from its allocation to inflation-sensitive and alternative assets, as these classes tend to perform well in a high inflation economy. These assets include infrastructure, real estate, renewable resources, and returned 8.4% over the fiscal year. Over the same period, fixed income investments returned 0.0%, and equity investments gained 0.2%. Overall, the fund remains well positioned to meet its target returns in coming years. With that, I will conclude my remarks and allow my friends from AIMCO to introduce themselves.
Thank you, Mr. Thompson. Good morning all. My name is Amit Prakash. I'm the Chief Fiduciary Management Officer at AIMCO. I'm joined this morning by Paul Langell to my left, who is the Chief Financial Officer, and Jean David, who is the Chief Economist of AIMCO. Our plan this morning, Mr. Chair, is for each of us to take 2 or 3 minutes. I'll start with providing a bit of an overview to the committee of AIMCO, given some of you are new to the committee. Paul will speak to the corporate strategy briefly at a high level, and Jean David will speak to the economic outlook, including a quick look into the rearview mirror. So AIMCO was founded in 2008 by the government of Alberta as a cost-effective investment manager for a host of investment mandates that are managed for Alberta-based entities. From our early days from 2008, we've grown now to manage $164 billion across 17 clients, which we do across 29 mandates for many clients, such as the government of Alberta. We manage more than a single mandate, including the Heritage Fund. Over this 15-year journey, we've developed capabilities across a host of asset classes, so anywhere from public equities, fixed income, private equity, infrastructure, etc. We also work closely with and have developed partnerships with industry-leading players that allow us access to investments across the globe to the benefit of our clients. And over that journey, new areas of opportunity as they evolve get added to the menu that our clients invest in, such as private credit, renewables, and in the near term, energy transition. And in all of these dimensions, there is attractive risk-adjusted returns that our clients have access to. And then lastly, this partnership with the Heritage Fund has been very productive, and it continues to grow. We've added cumulatively about $1.5 billion in excess returns to the Heritage Fund over the last 10 years, even as the Heritage Fund has grown to $21.2 billion. And finally, as Mr. Thompson mentioned, over the 10 years, the Heritage Fund has delivered 8.5% returns annualized and exceeded the policy benchmark by approximately 7 basis points per annum. And finally, we work closely with our clients, including the TB&F team, both as to implement the investment strategy as managers, but also in a consultative manner with providing research and advice to the TB&F team and other clients in support of the mandates. With that, I'll turn it over to Mr. Angelo.
Thank you, Amit, and good morning, everyone. As Amit mentioned, Paul Angel, Chief Financial Officer for AIMCO. So I'll provide a few brief comments on our strategy and our objectives. So our purpose at AIMCO is to help our clients secure a better financial future for the Albertans they serve, our clients serve. So last year, we did spend a lot of time developing our refreshed corporate and investment strategies, really with the objective of becoming a higher performing, more client-centric organization. So we are delivering on our corporate strategy by focusing on improving client trust and service, creating a more adaptable investment platform, which requires some investment and updates in our technology and data, and in executing on our people strategy to build the capacity and capabilities we need to better service our clients. And we are reviewing our operating model as we move forward. So with that, I'll pass it over to Jean-David for some comments on the economy and markets today.
Thank you, Paul, and glad to be with all of you today. Please call me JD going forward instead of Jean-David. And on that note, talking about the economy, the global economy, since the pandemic, we've seen that supply chains have healed on a global basis, and that's good because it means that the inflation within the goods sector has actually come back and normalized itself. Now, one of the problems that we're facing is inflation on the services side, as consumers have been benefiting and enjoying lots of excess savings as through the help of government transfers during the pandemic. So on the one hand, the labor markets in developed countries such as Canada, the US, the UK, and the Eurozone have started to become less tight. So we've observed a drop in job openings and also in the number of workers that are jumping ship to other companies. So this is a sign that the job markets is gradually coming in more into a balance. Now, as this process unfolds, we should begin to see less pressure coming from workers to get higher wages. In turn, services inflation should continue to decrease in the next little while and over the span of 2024. Although in Canada, it might be a bit conditional on rents actually decreasing as well, which we have yet to witness. Overall, we do expect headline and core inflation, so inflation excluding energy and food prices, to end 2024 at lower levels than currently experienced, but still above the 2% target of most central banks in the developed world. Now, as consumers are depleting their excess savings, growth is expected to slow down significantly in 2024 in advanced countries, and that should ultimately trigger a round of policy interest rate cuts from the various central banks, beginning probably in the second half of next year. And that could provide some relief to households and businesses. So in summary, picture a tree branch, and you have a host of canaries lined up. So the US canary is actually chirping. Canada, China, the UK, and the Eurozone are no longer chirping. And actually they're seeing their heads circling with the canaries because they are on the verge of potentially being somewhat knocked out. So that's a summary of what is going to come about us in 2024.
Thank you very much for that presentation. We will now turn to the questions on the annual report. In the last legislature, the chair of the committee kept a list of those who would like to speak and recognize members to ask one question and one brief related follow-up question. As much as possible, the chair alternate between caucuses for the questions, and if there are no concerns with that, I would like to continue with that approach for this committee. Does anyone have any questions or comments about that? Seeing none. With that settled, I just want to remind members that during debate, to get on the speakers list, those in the room are asked to signal the chair or the committee clerk, and members participating remotely should send a message to the committee clerk via your computer there. I'd like to now open the floor to the committee members to ask questions of our guests, and oh, lo and behold, Mr. Brar has a question. Please proceed, sir.
Thank you, Mr. Chair. My first question is that I can see on page 5 of annual report, the annual return of the fund in the fund's investment return was 2.6%, and it is written on the highlights page, a 5-year return of 6.4%. In the previous year, it was the annual return, whereas this year it is written as the 5-year return. So basically, the consistency of the reporting in the highlights page was missing. I believe that it should be consistent. If it was 1-year return on the previous year, it should be 1-year return on this year, so that we can have consistent idea of what's happening. In this case, it was different reporting last year. It is different reporting this year, and if we compare some data, we can see that this average of 2.6% is below the average of 5-year average, which was 6.4% as mentioned here, and that was even below than the 10-year average of 8.4%. So my question is that why is this not consistent, and based on the numbers, why is AIMCO not performing as it should be?
Mr. Thompson.
Yeah, it is actually a report, Treasury Report and Finance, not AIMCO. The stylistic presentation has changed, yes, but the information is all contained within the report. But we will certainly take your comments back to our communications division. With respect to consistency, I take your point.
Do you have a follow-up, Mr. Burr?
Yeah, so my follow-up would be for AIMCO. So basically, if this return has gone down from previous years, these numbers tell a story that AIMCO is not getting some good results. If we compare from decade to 5-year to 1 year. So, what is being done to improve that, and why is this return going down?
Thank you for the question. So when we implement on the strategy for the Heritage Fund, our focus is delivering on the investment objectives over the long term. We recognize that from time to time in the markets, markets will go up and down. And particularly what has impacted the markets, as was said as part of Mr. Thompson's opening remarks, is the fact that the inflation has gone up, interest rates have gone up, and therefore that's impacted part of the portfolio. And therefore, and the reason that the return for the fiscal year 22-23 is 2.6 reflects those market dynamics. However, as you correctly were looking at the 5-year and 10-year, you get a better sense of how the portfolio is designed and what it's able to deliver over the longer business cycle, recognizing that things will go up and down. As JD mentioned, things may slow down next year, interest rates may start to come off, but the portfolio is built and designed to work well across different cycles, knowing that some years will be low and some years will be high. Thank you.
Thank you very much, Mr. Prakash. And with that, we now go to Mr. Rosewell.
Thank you, and thank you for coming, and it's nice to see some of you guys again. I'd like to start by asking a few questions about the performance to build on to the last question. Just what classes of investments have performed well and which ones have performed poorly? And we've gone through some turbulent times this last year, and I was wondering if that has changed your long-term strategy at all, and if you can expand on what you expect for 2024, and if you expect inflation to improve and interest rates to decrease. You mentioned a little bit about that, but if you could just expand on that a little bit.
Absolutely, happy to do that. I'll start with describing where the first part of your question, where the performance, what has driven performance for the fiscal year, and we'll turn it over to JD to look forward into the question around interest rates and expected inflation. So in terms of the returns for this period, it is driven by the following. So the asset classes that performed strongly included infrastructure up 13%, renewable resources up quite strong, private debt up 6.5%, and even money market given Bank of Canada activity that's also delivered returns over the period. On the other side of the ledger, the strategies or the asset classes that performed poorly included emerging equities, Canadian equities, and private equities after having a stellar set of years, down 1.7%. Now, if you zoom out and look at the longer term, certainly these asset classes look a lot more attractive rather than that one fiscal year. And then lastly, in terms of the investment strategy, we remain focused on the longer term and ignoring the noise from the market, because at any point in time there are various things happening in the market constantly. And so the two-part answer is on a more granular level, how we position the heritage portfolio tactically. So we've been constructive and relatively risk averse, if you will, and that has served well. But over the longer term, the introduction of new investment sub-asset classes, if you will, such as renewables, such as private credit, and the evolution of the asset classes we have, that has served well as you look at the asset classes that did well and did poorly across this period. JD?
Thank you, Member Rosswell. So two elements are interconnected for us to be cautious on the macroeconomic outlook. So the first one is that inflation, we believe for a host of reasons, is not slated to diminish back to the 2% target of the Bank of Canada, for instance, domestically. And so there's many reasons for that, but the trend is the proper one. So inflation is indeed decreasing. However, the question is how fast it could be going back to the 2% target. The Bank of Canada is forecasting that this could happen by sometime in 2025 only, not next year. We are of a similar view to that as well. And then it begs the question, what is that second element of the interplay here? It goes back to the central bank reaction function. So central banks, the Bank of Canada, for instance, would be glad at some point to provide some relief to everyone by reducing policy interest rates. However, it is conditional on how successful their policies can be in trying to tame inflation. And given that we believe there's going to be a little bit of a delay in trying to get much closer to the targeted 2% inflation rate for headline inflation, well, then it means that we are in for a higher rates for longer type of environment, in which at some point will make it more challenging for households and businesses to conduct their regular affairs, and that is why growth will be slowing down much more significantly at some point in 2025. I hope those are provided some more detail.
I know that relative to classes like this has probably been a tough year for bonds. Just the value of them, right? Which is that's how they work. I was just curious if you are you going to take this opportunity to lengthen the duration, or is it too early to do that? Like, have you had a shorter duration over the last 10 years, and is this an opportunity to lengthen it, do you think?
So we've done, so we were effectively in that mode, and reduced, if you will, our relatively shorter position in duration. Our current investment guidelines allow our teams to be plus minus 1 year duration relative to the benchmark, which is roughly around 7.5 years. So we certainly use that limit prudently, but use that in conjunction with whatever else might be going on in the portfolio. Over the longer run, we do recognize that big portion of the performance of investment pools of capital, such as the heritage fund, is driven by the longer term asset allocation, but over the shorter term, we clearly make those changes. And then the last one I'll add, which we did in conjunction, working closely with the TBNFT, was to change the limit that we are allowed to invest in the private debt and loan, which has a very short duration, so roughly 90 days, as opposed to the bond vehicles, which are multi-years. And that has been profitable for the fund, and the private debt and loan pool is up about 6.5% relative to flat for the bonds. So those are some of the types of things that we do.
Thank you.
Thank you with that, and we go to Mr. Kennedy.
Thank you, Mr. Chair. Question about the policy review that you related to, Mr. Thompson. As far as I'm aware, I think that the previous committee asked about this in March. As far as I don't believe that there's been a policy review done since 2020. I may be wrong on that, so please feel free to correct me.
Yeah.
And so I guess my question is, there is supposed to be a policy review that's done, regularly. And then the second thing is that, as you pointed out, there have been major changes in risk reward trade-off, again, as you point out. And so, where's the status of that? Have you had any discussions with TF about that, and do we have a plan in place?
Yes, we do have a plan in place. And the policy was last updated in January of 23, so the policy is continuously updated. What you're alluding to is a formalized asset mix study, and we did an RFP to select an external service provider to assist us in that project, which is currently ongoing. That RFP was awarded in February of.
Issued in February.
Issued in February, sorry.
And we selected somebody in June.
Yeah, and we have selected a partner in June. We are working with them currently. The plan would see that formalized review finished towards the end of the fiscal year. They have been in consultation with AIMCO and ourselves. We are taking into consideration the legislative changes that have since been made to the plan, the changes to the inflationary environment, global macroeconomic conditions, and changes brought to asset classes. These are all things that will be considered under this formalized review. But that is in fact from when we say we do review this policy annually. That is done with not less rigor, but less focus. It assumes that the policy in place is robust. We will test it for weakness with our partners, AIMCO typically, and internally. But this external piece is much larger, and it is, again, in the context of sort of changing fundamentals around the plan.
Thank you for that. That's really encouraging, and I'm very pleased to hear that. So what do you, so what kind of changes would, like what's the difference then, I guess? So like in the annual review, like what kinds of, like what would you have done this year compared to like the broader?
Sure. No, happy to ask that on that. So Mr. Prakash alluded to changes that were made in the private debt and loan portfolio. Those did require small changes to policy. So allowable ranges changed by 1 or 2%, I believe, to 2.5%. Thank you. 2.5% to allow for a greater investment in that asset class because it is providing greater returns and is more appropriate in current fiscal or financial market conditions. What we're looking at with the broader piece with our external partner is the full recast of the asset allocation, potentially a review and potential recast of the asset allocation as we currently know it, and possibly more significant changes to the statement of investment policies and goals. Again, to reflect changing direction of the fund or changing legislative authority on the fund and different inflationary and global market dynamics.
It's now Mr. Rosewell.
Yeah, on page 10 of the annual report mentions how the fund's per capita market value peaked in 1983 at $12,380 per Albertan, and since has declined to a recent value of $4,500 roughly per Albertan. The decline resulted from allocation of resource revenue to the fund being terminated and the fund's earnings being transferred to general revenue and Alberta's rapid population growth, especially currently. Given that the fund is now able to retain all of its investment income, how can we expect the per capita value to increase once again?
Sorry, happy to answer that. It does involve forecasting the future, which is difficult as we know. The significant growth that we saw in the Heritage Fund over the years has been while funds were being contributed and retained. So we can't expect that the fund will grow quickly, assuming that all investment income is retained in the fund. And really to achieve a higher per capita increase, that rate of growth simply has to exceed the rate of population growth in the province. I don't know if anyone wants to add anything to that.
No, so yeah, I think Mr. Thompson covered it well. So it's a function of what the denominator is normally, what the population growth is, and how the dollar value of the fund grows, and that is both a combination of the contribution or retention as well as the growth in the markets. The forward-looking view in terms of the expected returns from the market is potentially lower relative to over the last 10 to 20 years, and some of it is given the interest rate cycle where we are, amongst other things, and potentially a higher level of inflation. But that said, it's the combination again of the growth in the markets, the contribution and retention, and then the population.
And has there been any information or goal of how big that would like to grow to, or like is there a number that we have that you have that you've been showing that we'd like you to get to?
We don't currently have a target for
Okay,
that.
fair enough.
We've had the single contribution to the fund since 2008.
86.
And we haven't retained income in the fund in the same period, so it's hard to judge. Once we have direction from government, we can probably project some things.
Sure, fair enough. Okay, I appreciate that. Thank you.
We'll now go to Mr. Kozowski.
Thank you, Chair. So the question I have, I'm just not sure if I direct it towards you or that direction.
Yes, through the chair.
Okay, great. So in the strategy for the Heritage Trust Fund, there is a description of opportunistic investment, and the investment manager is able to use up to 2% of the fund for opportunistic investment. And so for me, I'm just looking for an example, maybe from this previous fiscal year, the use of an opportunistic investment. And if there's not one from the most recent year, they can go back further and give an example and just give us as fulsome an explanation of that as possible, just so I understand how they use that ability and that strategy.
Thank you, sir.
Thank you. Great question, and very topical. So we use the opportunistic bucket particularly for investment opportunities which do not fit very neatly and cleanly into the more traditional asset classes. And that is simply a reflection of how the markets have grown over the last 30 to 40 years. We see that already in fixed income, for example. So if you looked at fixed income 20 years ago, you would see investment grade, non-investment grade. By and large, if you look at it now, there's a whole range of investment activities, anywhere from liquid high yields to private credit, direct lending, loans, etc. And so within the opportunistic bucket, you see that the allocation that the Heritage Fund has is a very small number, 0.3%, and these are legacy investments from over 5-7 years ago. We haven't been active in that space. We are, however, working closely with Mr. F and team and our other clients on an opportunity on energy transition, where we think there are attractive investment opportunities across the globe to harness the premium or the excess returns that one can invest by taking advantage of the opportunities and transitioning companies which otherwise have really good business models, but have been punished by the market given their energy characteristics. And so we do expect, as we are working through the clients, that next year we would be able to start making investments in this opportunistic bucket, again with the eye to have seeking attractive risk-adjusted returns on behalf of our clients.
Do you have a follow-up, sir?
I have sort of two. Am I allowed to try to bring them into one?
Give you some leeway there.
So in the money market section, it feels like it's a smaller amount, and I just want to make sure I might be remembering that wrong. Then we can take advantage of it. And then with regards to that, I guess that would be 420 million. Just help me understand the oversight that has to be gone through in order to place like an investment. If you're allowed that 420 million that you're allowed to put into opportunistic investments, what is the oversight that goes into making a decision like that or a placement like that?
Yeah. So we have a very formalized governance structure in place. But the first part of the journey is the client mandate. So across all clients, including Heritage, in terms of what we are allowed or not allowed to do. And how that clients instruct us, including Heritage, is the statement of investment policy, which specifies that you can do X% in equities, Y% in money market, etc. The second part that governs that process are product descriptions, which describe the money market pool, the types of investments we have, the concentration risk, the return targets, the excess return targets, etc. So that's a pretty formalized documentation of what that pool or investment vehicle is supposed to do. And internally, it goes through a rigorous process, and ultimately, the AIMCO board will sign off or approve the pools, and the process continues to evolve and becoming more efficient. So that's effectively the process. And then last but not the least, our reporting of the performance of the Heritage Fund, describes that fully, including the holdings, etc. And finally, there is an audit process that reviews the money market in addition to all of the other investments.
Yeah, I would just add to that, our role at Treasury Board and Finance with respect to those allocations is to ensure that any products still meet our required risk and return parameters. Transition finance, for example, we would expect that be analyzed purely for its economic and financial returns, and that they would be additive to the fund in some way.
now to Drayton Valley Devon, Mr. Bochenko.
Thank you, Mr. Chair. I would like to ask about the ways you measure risk on the equity assets in the portfolio, and specific on what are the specific metrics you use to determine a risk?
Thank you. That question near and dear to our hearts because we love numbers. And for equity, like other asset classes, we look at a multitude of metrics. And so just to give you a flavor of some of the things we look at for equities. So first and foremost, we measure something called the beta of the equity portfolios, and what this measures is how an equity portfolio behaves relative to its benchmark, relative to the market. And effectively what it does is that if you see a beta of, let's say, 1.2, what that tells you is that the portfolio is taking potentially a greater amount of risk than its benchmark, than the market. So that's one metric we use. We look at another metric called tracking error. And what the tracking error does is that it looks at the dispersion that your portfolio has relative to the benchmark on which the policy makes set by funds. And that effectively sees that if the dispersion is really large, then the portfolio is doing something different than the benchmark. And if the dispersion level is low, then it's doing something that is similar to the benchmark while taking its active position. So that's the other thing we do. And these measures, if you will, one can think of them as statistical measures or risky measures. We also have other risk parameters that are more guardrails in nature, such as country exposure, sector exposure, single strategy exposure, single security exposure, such that forces the portfolios to be diversified across all dimensions, country sectors, single securities, etc. And so that's the gamut of the risk measures that apply to equities. And finally, at the overarching level, we also look at the risk at the total portfolio level, which obviously looks at the equity component, but it also looks at how the equity risk behaves relative to other components of the portfolio. So that gives a 360 view of the risk.
So there are check and balances to determine the risk there. Okay, thank you. And I have a follow-up if I can. Can you talk about the ways you manage equity investments against inflation, currency, and interest rate risk in these uncertain economic times?
Again, great question. We spend a lot of time thinking about that. So firstly, I'll just take it in that sequence. On the currency risk side, so the place we start is again with what the client's benchmarks or objectives are. So our equity benchmarks or our clients' equities benchmarks are currency unhedged in that there is exposure to foreign exchange as part of the equity exposure. And so we utilize that as a starting point before we decide to hedge in certain cases or not. So that's number one. Number two, on the inflation and interest rate risk side, the mechanism typically of the pass-through of those metrics or those macroeconomic conditions impacting the portfolio is from a growth perspective, from an earnings growth perspective, and as well as the growth of the overall economy and how that impacts different economies. Our positioning of the portfolio in a more conservative manner is driven by those decisions, including how much active risk we're taking in these portfolios. So if you look at our current active risk, for example, in equities, it's running at a relatively low level relative to the limits that are applied, and that's just as an example of how we position within a mandate and within the guidelines.
Thank you so much for that, sir. We now go to Mr. Kennedy.
Thank you. You've mentioned a couple times now about
So, thank you. So this is our renewable resources primarily invest in timberland and farmland investments. And but before I speak specifically to the asset class, maybe by way of background, across the markets, because of changes in the market and the background, different opportunities arise over the last 20, 30 years. So think about internet going back 15, 20 years now, age myself. Think about after the great financial crisis, 2008, 2009, the bank balance sheets were hurting. They started to pull back. And now the private credit asset class started. It is $1.5 trillion now, and it's been really attractive. But there were changes in the market that led to this asset class. Our renewables investments started within our infrastructure, but as that area has continued to grow, it has become, if you will, a sub-asset class or asset class, depending on your preference, in its own right. And particularly where investors such as the Heritage Fund, it finds a natural place is the, as I mentioned, timberland, farmland investments, as well as we invest in integrated agricultural companies that operate farms as well as process crops and produce. Now, what is attractive about this asset class and as it has grown is that it is pretty highly correlated with inflation, and you can see the intuition quite directly. As inflation goes up, the prices of trees, the prices of commodities more general, crops, grain, produce, etc. Grow up. Now, at the moment, it's gone up for economic reasons as well as the geopolitical risk events, and both have driven the higher return in this asset class. And we particularly have benefited from the investments we have in Australia, New Zealand, and the United States, and it's an area that is, albeit 3% of the portfolio, remains quite attractive as an inherently an interesting area to be looking at. So that's the renewable. The energy transition, just to complete the thought, is something slightly different, but in many ways also in its incipient stages, that increasingly there is a need, and sometimes it's policy driven, sometimes it is simply where the markets are naturally going, of managing the risks from climate. So purely from a narrow lens of attractive investment returns, there are opportunities in this place, in this space, that would be attractive for for institutional clients. And there's a fair bit of work done across the industry in this space, and primarily driven by the changing backdrop across the globe in this space.
So when you talk about farmland then, or farming operations, like those would be exposed to like the renewable natural gas provisions of the U.S. Production Act, for example. Like, is that like, I'm just trying to figure it out in my head.
Yeah,
Just trying to pull on that.
So some of that is absolutely impacted by, sorry, apologies.
Sorry, I know it's a weird kind of call and response thing. I do like having just a conversation about it. And so when you look at the returns that we had in that portfolio, was it primarily mark to market then, or were there exits that actually realized some of these gains?
So we actually realized some of the gains in the renewables portfolio. That is reflected in the returns, and certainly the longer term returns. One of the more attractive ones was Eolia Renewables. We sold that 2 years ago across our clients. It was a very attractive transaction. And some of that is simply what we see and hear in the news around the growth of renewables across the globe. That particular holding was in Europe, and over a holding period of 2 to 3 years, it grew quite dramatically as the need that's just an example of why this asset class is attractive. On a more technical basis, this asset class has an inflation plus benchmark. So what it does is over short periods of time, the portfolio does well, it looks dramatically better. Or if it does poorly, because the benchmark is relatively a flat line, a slow moving flat line, compared to the public markets where the benchmarks will also go up and down.
Thank you very much, Mr. Prakash. If you guys, sorry, Jim. All right, then with that we go to Mr. Bochenko.
Thank you. Although the risk can rarely be entirely eliminated, there are many strategies that can be used to minimize it. For bonds, duration is a common measure of the sensitivity to the interest rate fluctuations. Can you provide some information on what duration is and why it is a good risk measure for bonds?
I will handle that question. Thank you for the question, Member Borchenko. So let's go back to the basics of bond investing just for a second. So when interest rates rise, well, the value of bonds typically go down. This is just the mechanics of bond math, and vice versa. So now the duration as a measure of that sensitivity to interest rate behavior is one of the key measure that all bond portfolio managers would use to provide the risk-adjusted returns. So let's pick it on an example here. If the duration of a specific portfolio has a unit of 5, what does that mean? It means that if interest rates do rise by 1%, then the portfolios tend to lose 5%. And vice versa. If interest rates go down by 1%, then the portfolio, if the duration is 5, would stand to earn returns of 5%. So now, at INCO, we typically manage the bond portfolio, and in particular, say, the universe bonds portfolio, to be close to its benchmark. And as of March 31st, 2023, the duration of the universe bonds portfolio was around 7.4 in units term, and the benchmark was at 7.3. So very, very close matching of how we manage the actual underlying portfolio in terms of its duration to the duration of the benchmark that it is tied to.
I have a couple follow-ups, but I'll narrow down to one follow-up here. Have you made any changes to better adapt the fund to deal with the large increase in inflation and interest rate over the past year?
Indeed, and I will go back to the example that we've discussed a bit earlier, which is the addition of some assets within the private debt and loan segment of the Heritage Fund portfolio. So, as Mr. Prakash has hinted at previously, the actual duration of private debt and loans is very short in nature, so just 90 days on average or thereabout. And therefore, in an environment where interest rates are rising, it is actually quite profitable to be positioned with more assets that would react in sync with interest rates rising. And so floating rate assets, the types that are embedded within the private debt and loan portfolio that we manage on behalf of the Heritage Fund do provide that sort of protection or match to the behavior of underlying interest rates. So as interest rates have risen in the past 2 years, therefore adding more on the private debt and loan side for the Heritage Fund has proven to be a very good decision.
Thank you.
Ms. Gray, you have the final question.
Oh, thank you very much, Mr. Chairman. My question was actually exactly along these lines, looking at interest rates rising and how the Heritage Savings Trust Fund and how INCO manages for that. And I guess I was thinking about interest rates increasing and that impact on mortgage renewals. And then I know in our portfolio we have commercial real estate. And so do we anticipate or do we think about if people start perhaps defaulting on mortgages or commercial real estate holdings becoming less of a solid investment opportunity, or how is the fund thinking this will play out and how it might impact our portfolios on that aspect?
So again, thank you for the question. So a couple of thoughts. So our mortgage portfolio owns roughly about, they own mortgage loans, and about 70% is core, 30% is specialty or more opportunistic. So that's roughly the design. And when we are looking at opportunities in the markets, we are being again quite careful, given where we are in the business cycle, that we are only positioned in those areas where our underwriting allows us to be quite comfortable with the exposure that we have. Now, from an interest rate perspective, again, mortgage similar to private debt and loan, the exposure is pretty short, so that part you're naturally hedged, if you will. And then the second part effectively just goes to the underwriting of the security selection process, where we are rigorous in terms of what we pick. Now, we know that our portfolio, any portfolio, is not 100%, does not 100% remove all the risk, otherwise the expected returns would be adversely affected. But we spend a fair bit of time in terms of the selection to ensure that the portfolio is robust. Lastly, if we look at, and some of that is reflected in the performance of the mortgage pool, so it's up about 2.6% lower than, and apologies, I'm using this the most recent year-to-date numbers, just to give you a flavor, that even within this environment, that portfolio is up around 2.6% relative to the universe bonds, which is up around 1%. So reflecting both the security selection as well as the duration of those portfolios.
Perfect. Well, and just hearing JD talking about how this asset class and the benchmarks tend to be very closely aligned. That's what we see here. Like when I first started looking at the fixed income asset, I thought, oh my gosh, it's so much lower. And then but we're beating the benchmark. So okay, that's what's happening there. I guess my question around this asset class in general, and I understand that you've hired a third party to do this study, but we currently have about 20% of the Heritage Savings Trust Fund in that fixed income asset class. Do you anticipate that would significantly change as a result of the asset mix study, given what's happening right now, or having 20% in fixed income, would that likely stay as a good consistent amount, and the adjustments within the class, or what would change?
Well, I don't want to prejudge the outcomes of the study. And I think the whole goal of that study is actually to ask that very question. So I think we'll be in a better position to come back and report once we have something in hand. But I wouldn't be surprised by changes in allocations across the board.
We have next Mr. Bouchard.
Thank you, Mr. Chair. I guess, the question of whether active or passive fund management offers better returns is contentiously debated in investment circles. One of the fund's stated beliefs is that allowing AIMCO the latitude to make active management decisions greatly enhances their ability to add value to the Heritage Fund. Can you expand on what percent of your portfolio is actively managed, and why is this the correct approach?
Thank you for the question. So all of the mandates that we have for the Heritage Fund are managed in an active manner. A bit of context around that, I think I said we find it quite helpful. So if you think about private equity investments or mortgage investments, infrastructure investments, the notion of passive is a little academic in those, in that there isn't a S&P 500, if you will, for infrastructure investments or PE investments, etc. Primarily given the nature of that. So by design, if you will, by construct, by construct about close to 60% plus of the portfolio of the Heritage Fund is inherently in asset classes that the passive is would be difficult to describe in a more precise sense. Outside of that, more generally, why an active approach is attractive for pools of capital, such as the Heritage Fund, is that it allows Heritage to play to its strength. So think about investment pools of capital with 20 billion plus a 21.5 billion as Heritage is, relative to smaller investors, relative to all of us as individual investors. It has the benefit of long investment horizon. It has the benefit of not necessarily needing to pay the rent bill every quarter. And to the extent that as an investor you have the flexibility of the long horizon and potentially to take on a bit of illiquidity, that plays to your strength. And part of the rationale, a big part of the rationale of excess return comes from actively managing the portfolio, given the advantages of the Heritage Fund.
Thank you.
Do you have a follow-up, sir?
I do, yes. I think it's page 7 of the annual report mentions the fund's active management target, which helps to evaluate the investment manager's value-added performance over time. Now, could you further elaborate on the fund's active management targets?
So our process of setting up the active or the excess return targets for each of our funds, each of our pools, equities, bonds, etc., is a process that involves us working with our clients, all of our clients collectively, in landing on or deciding upon the investment characteristics of those vehicles. So for equity funds, our excess return targets, the risk it will take, where to invest, benchmark, etc., is something that we do in conjunction with all of the clients. And what drives the return and the expected return, risk, and other characteristics is effectively the investment needs that is reflected in the policy mix of our clients. So to the extent that we take moderate risk in our equity portfolios relative to other managers, it is simply because that is what is fit for purpose for our clients more broadly. So that's how, whether it's equities or any of our other investments, that's what we do, and that is how and therefore some of the more topical thing that one might read in the press, whether it's crypto, etc., don't find our way in the portfolio simply because the risk profile, it wouldn't make the risk profile, and that's why they're not held in the portfolios.
Perfect. Thank you.
Do we have any further questions from opposition side? With that, Mr. Weed, you had one more final question.
Thank you, Mr. Chair. As mentioned on page 9 of the report, the annual report, legislation has required inflation proofing to protect the fund since 05-06. This, of course, is important now more than ever to help protect the assets of the fund. How does inflation proofing process work?
Thank you, Member Lee. So the inflation proofing aspect is actually written into our legislation. It's on section 11. It's a little bit complicated to understand, but it's last year's accumulated surplus. So essentially, what the fund is worth after it was to pay out any type of liability is multiplied by the change in the consumer price index in Alberta. And this can be found as part of the economics team as well too. They publish this online. So it's the 12-month change. So right now we're looking at about 4.3%. So 4.3% is multiplied against what the fund value was last year. And then that is our inflation proofing number. So that is what has to be retained within the fund. So we were looking a few years ago at about 300 million was retained, and now we're looking upwards of like 800, 900 million. So over time, that has actually helped grow the fund by $5 billion since it came into inception. If for some reason that year-over-year change is negative, and again, the performance target of the fund is the Canadian CPI number, the inflation proofing is linked to Alberta. If that number was to be negative or zero, then inflation proofing would not be applied for the year.
Follow up. So you may have answered this already somewhat. What are some examples of good inflation proving assets?
So Mr. Prakash actually alluded to many of these. So we have a section in the investment policy of inflation, of alternatives and inflation proofing assets. So real estate, infrastructure, renewable resources. And these also have inflation linked benchmarks within the report as well.
Another question, Mr. Chair.
To the opposition, did you guys have any final questions? No. That's fine, then Mr. Reed, go ahead.
Okay, so on page 11, I would like to discuss the table showing the asset class returns compared to their benchmarks. And I see that the infrastructure returns almost doubled their benchmark. This is labeled as an inflation-sensitive asset. I'm wondering if it is, or if it was inflation or a combination of other factors that played a role in these large returns.
So again, thank you for that question. So a two-part answer. So firstly, I'll start with the more technical one, the fact that over short periods of time, given the CPI or the inflation type benchmark, it can deviate, but if the 5-year numbers are more comparable and only about 60, 70 basis points apart. So that's number one. Number two, you're exactly right. The reason why why infrastructure, amongst other things, has done well is the link and the benefit many of those investments. Think of toll road where the tolls go up, or water utility, etc., where the bills go up as inflation goes up. So that inflation protection or inflation hedging is part of the DNA of infrastructure investments, and typically the holdings we have tend to be contractual in nature, where for the next 20 years you'll get certain payments, whether it's energy, whether it's water, whether it's any other public utility. And then lastly, one of the investments that we held in this portfolio that has done well is we own in the midstream sector Howard Energy Partners in the US. And that has been a really, really stellar investment with the continued renewable energy projects that has successfully executed on. This has also benefited, to the question earlier, from the Inflation Reduction Act, and particularly this has elevated some of our partners within the infrastructure portfolio. And that's what when I was referring earlier to the ability to take advantage of what's happening in the macroeconomic, but as well as in public policy, when appropriate, as appropriate. But our focus always is on doing our due diligence to deliver on the return targets.
I also had a follow-up on the returns on the renewables, but I think you have already answered that, so thank you for the questions.
And with that, if there are no other questions, this will conclude our discussion of the report. Now the committee has to consider a motion to approve the annual report. So the committee clerk has some wording for a potential motion, and we'll post it on the screens in the room and on the video conference. We will need someone to move this motion, if anyone would like that honor. Let's go to Mr. Kozlowski, please.
Thank you, Mr. Chair. I move that the Standing Committee on Alberta Heritage Savings Trust Fund approve the Alberta Heritage Savings Trust Fund 2022 to 23 annual report as distributed.
Is there any discussion? Can I ask all in favor of this motion?
Aye.
All opposed? Carried. Thank you very much for that. We're now going to move to our review of the fund's first quarter report for 2023-2024. This report was prepared by Treasury Board of Finance in August and made available to the committee after the committee was struck. As was said earlier, the Alberta Heritage Savings Trust Fund Act requires the committee to receive each of the quarterly reports. We're now going to hear a presentation from the Treasury Board of Finance and AIMCO officials on the first quarter report. Please proceed.
Mr. Chair. I'm also pleased to present today the quarterly results for the Alberta Heritage Savings Trust. The first quarter results provided a much more promising start to the fiscal year 23-24. Investment income was significantly higher than the prior year actuals. This increase was primarily driven by strong performance in the fund's equities due to notable improvements in the global financial markets, which resulted in the fund delivering substantially higher returns than the previous year. Over Q1 23-24, the fund returned 2.0%. This compares very favorably to the 4.1% loss experienced in Q1 of the previous fiscal year. These results mirror those of most global market indices, including the S&P 500, which rebounded from a 13.4% loss in Q1 22 to a 6.3% gain in Q1 23. As discussed previously, the fund is compared to a target return in Canadian Consumer Price Index plus 450 basis points, measured over a 5-year rolling period. The target return increased from 6.7% to 6.8% over the quarter, or at quarter end, due to persistent inflation. Over 5 years, the fund return was unchanged from fiscal year end at 6.4%, which is now 40 basis points lower than the target return. Over the last 10 years, the Heritage Fund earned a return of 8.5% annually. Over 5 years, AIMCO, our asset manager, has delivered an active return of 60 basis points above the passive benchmark return. The fund return of 2.0% over the quarter outperformed its passive benchmark by 30 basis points. As a reminder, the return of the entirety of the last fiscal year was only 2.6%. As of June 30th, 2023, the fund had produced $778 million in investment income, with 3 quarters remaining in the fiscal year. After investment expenses of $39 million, this represents net income to date of $739 million. The fund began fiscal year 23-24 with a net asset value of $21.2 billion in comparison with $18.7 billion at March 31st, 22, due to the retention of income and contributions to the fund discussed previously. The net asset value of the fund continued to grow over the first quarter to $21.7 billion as of June 30th, 2023. This growth was a result of positive investment performance on the larger underlying base of assets. This will conclude my remarks for Q1.
Thank you, Mr. Thompson. I'll please give you just brief remarks. So the Heritage Fund was up 2% relative to its policy benchmark of 1.7%, or a value add of 0.3% for the quarter. While it seems like distant memory right now, the beginning of the period did have its fair share of shocks into the system. There was a regional banking crisis in the US that was front and center. We had the recurring public US debt ceiling impasse in the US. And in the midst of this, fortunately, the market looked through the noise, and the equities were up the quarter, and you see that reflected in a 3.1% return in public equities. And the markets, though it's we're clearly not there yet, as JD mentioned, the markets were also starting to get a sense of that inflation may start to taper off, albeit not to previous levels, and that was attractive as well. And then lastly, through the cycle, not surprisingly, inflation sensitive and alternative assets class continued to do well. And a couple of final remarks in the relative and active performance, certainly in fixed income and credit. As I alluded to earlier, we had greater exposure to corporate bonds or credits rather than government bonds over this quarter, and that resulted in roughly 25 basis points of outperformance. And then finally, on the inflation and inflation sensitive, we've already talked about infrastructure. One of the other investments is worth mentioning and referring to a previous question. In the renewables and infrastructure space, we sold a company platform called Verisent India. This was a renewable energy platform that we had co-founded and focused on the largely fragmented market in India. And then we saw double-digit returns for this investment as we sold it through the quarter at a very attractive price. So that's reflected in the returns for the quarter. In summary, again, 3-month period, but up slightly with small value add. Thank you.
Thank you so much for your presentation. Now we're going to turn to questions from the members. And first, we have Mr. Campbell.
Thank you. Just a question about, so just to pull on Ms. Gray's thread earlier about the inflation-sensitive assets, because while you've said that your credit portfolio is short duration, is very robust when interest rates are going up, the mark-to-market on these infrastructure assets is going to go the other way if they've got the same variable rate debt that you're buying in the market, right? And so I'm just curious about how you think about the mark-to-market on those inflation-sensitive assets when it's possible their valuation may be dropping even though that their cash flow is good.
Thank you for your questions. I'll start and maybe I'll ask Mr. Langell to talk about the valuation and the process we have around that. So you're right, these asset classes benefit the portfolio, and in that they have different attributes, which is why in a portfolio context they work better as a collective relative to an individual asset class or individual investment. So an attractive part of infrastructure, amongst other things, in some ways the boring contractual asset class you trade coupons for years and years. The inflation aspect of it is beneficial to the extent inflation hits, but even if it hits steady state or declines to a number lower than now, what that means is that the expected return, the inflation hedging part, that number declines at the margin, but the asset still remains attractive. So for years and years, it was an attractive asset class. Inflation has hit for the last 2 years. It's jumped up, and to the extent inflation stays at this a slightly lower level, it is still quite attractive, but it's not as if it would get hit. Now, as interest rates have gone up, clearly all asset classes across the spectrum get impacted depending on which line of business you're in. But it's not necessarily the case that you would be severely disadvantaged if the inflation comes off and or the interest rates also come off. So in that sense, it's helped with the hedging part. The hedging attractiveness shrinks at the margin, but the fact that you have contractual rates over 10, 15, 20 years, that part still remains attractive.
So basically you would characterize your infrastructure real estate and infrastructure assets as being less sensitive to interest rates because they have long duration debt on them. Is that part of it, or like how often do you recalculate the mark-to-market on these assets?
So these ones, just to clarify, so many across infrastructure and real estate, we typically, when we are, what you see in the portfolio holdings are by and large equity holdings, rather than infrastructure debt or real estate debt. Where we see the real estate debt, for example, is more the mortgage portfolio where that is more concentrated, rather than the debt in a real estate portfolio. So real estate absolutely is impacted by interest rates unambiguously. Again, given long-dated future cash flows. But what I was saying is that the inflation hedging part becomes more attractive when inflation inches up as that comes down, that part, that shrinks. But the asset class, just in terms of the rental income, for example, yield that you get from real estate, that part doesn't diminish. One other quick sidebar on real estate. So whilst the part that has been over the last 2 or 3 years, particularly through the pandemic and post, the focus, the headlines in real estate has been around the retail, the shopping malls, etc., and secondly, the commercial real estate in terms of people working from home. But a big chunk of the heritage portfolio is invested in logistics, invested in data centers, invested in a whole slew of other attractive areas which are growing. So think about Amazon and all the fulfillment centers going across, certainly in Canada, but everywhere else. And the data centers that enable the online ordering and all the things we do online. That part of real estate has been quite attractive, but it doesn't get as much ink as the ones that you see in the front page.
Thank you for that, Mr. Prakash. Now we go to Mr. Butchenko.
Yes.
Oh, sorry, go ahead.
Sorry, yes.
My apologies.
Just to address your question on the valuation of the private debt and loan portfolio, so we value that portfolio, it's a private portfolio. As Mr. Prakash said, that portfolio is basically floating rate. So you're not gonna get a lot of movement in the mark-to-market based on changes in interest rates. However, you do get some based on change in credit spreads, as it is a risky portfolio in the sense of credit. So what we do is because they're private names and they're well diversified, what we do is we look at and develop ratings for those entities, and we proxy those to published external rating agencies, and as well as our own internal rating capabilities. And then we look to the market and see how those spreads have changed in those ratings by sector, by geography. And we update our models every quarter for those changes in credit spreads, and we have a mark-to-market. But the mark-to-market changes in that portfolio to date have been pretty benign.
Infrastructure, maybe just a minute, infrastructure valuation?
Well, infrastructure valuation, again, they're quarterly on the private side. But I would say on those, like private companies, Eolia, other, Howard, for example, most of those are really done on an annual basis. Because that's when you get a refresh of the budget, transactions, look for comparable transactions. So we update it best we can on a quarterly basis, but we do pretty much a deep dive at the year end.
Thank you very much for that.
Okay.
Thank you very much, Mr. Wingo. And with that, now we go to Mr. Butchenko.
Thank you, Chair. Page 2 of the first quarter report outlines Alberta Heritage Savings Trust Fund's overall investment performance against the policy benchmark. I was thrilled actually to see that the returns were higher than this benchmark, but I'm still curious, how is the policy benchmark determined?
I'm gonna start and even if Dave wants to add, so simply put, the policy benchmark is calculated by 2 sets of inputs. So firstly, the various benchmarks that apply to the different investments that the Heritage Fund has. So for example, for Canadian equities, it is the S&P TSX index. For global equities, it is the MSCI global index. So what this calculation that you see here, the number, looks at what the returns for that index or benchmark is for that period, and multiplies it by the policy weight that the Heritage Fund has. So if you have 10% in global equities, which is up 20%, it's it adds 2% to the overall policy benchmark. You sum it up across for that period, and that's how you get a policy benchmark return.
And the follow-up, if I can. Sure. How much risk is AIMCO taking relative to the policy benchmark?
So relative to the policy benchmark, we measured it using a metric specifically that we report to clients called active risk or active active value at risk. So currently, we're taking roughly 4% active risk. We're allowed up to 11%, so we're at the lower spectrum, lower range of the active risk, but that's the number for the moment.
We now go to Mr. Kozowski.
Well, thanks, Mr. Chair. So, given the early and longer wildfire season that we experienced this year, and with timberland burning, infrastructure and real estate being destroyed by extreme weather events, the insurance industry under stress from claims and costs, did wildfires impact any investment in Q1? And more generally, how are we incorporating risk from climate change into Heritage Savings Trust Fund investment management?
So again, thank you for the question. So there wasn't a direct impact, fortunately, from the wildfires into the portfolio. Clearly, a big human tragedy across the globe in the province and elsewhere, but did not impact the portfolio directly. So first and foremost. Secondly, in terms of over a longer horizon, how do we manage for those types of risks? So we do believe climate risk, like any other risk, needs to be understood, measured, managed. And so every single investment that we do, every single private investment that we do, there is an assessment. There is a ESG assessment, including climate risk assessment of those investments. So for example, we described that you own farmland and timberland in Australia amongst other geographies. As we were looking, as the investment team was doing the due diligence around that, there was fair bit of work done to assess, understand the rain patterns and how it might get impacted by climate change 5 years, 10 years. Now recognize that that's not an exact science, but a fair bit of time is spent understanding those types of considerations, including policy consideration in those geographies. And so that's how we're navigating it. And a core principle of how we run investments is the integration of climate risk and ESG more broadly, climate risk more specifically, as we assess the investments. And then the last thing to say is that we continue to invest and improve in that measurement, in that reporting, alongside the industry. Clearly, it is a growing space, but we spend a fair bit of time in understanding it, just so we can manage the risks within the portfolio, as well as identify the investment opportunities that the climate considerations give us to.
Maybe just supplement that a little bit from a policy perspective from TDF is what we expect of AIMCO in consideration of ESG parameters is that they be used as a risk measure and evaluation tool, and not as part of the thematic investment. There are often trends in the investment industry which seem to be absent that rigor. So we acknowledge that ESG factors will impact the valuation of all of our asset classes, but we do expect of our asset managers that they stick to the guidelines, that they be focused on maximizing the financial return of the plan.
Absolutely.
No problem.
Perfect, thank you with that.
Mr.
Boucher, I'm sorry?
Butchenko.
Oh, Mr. Bojchenko, go ahead.
Thank you, Mr. Chair. I can also see on the page 2 that the asset allocation of the fund is highly diversified, with significant stake in real estate, private infrastructure, and foreign equity. This is contrary to some of the assumption made by the opposition that the investment of AIMCO are not diversified enough and put fund at risk. Could you please explain how you go about allocating investment in order to maintain a well-diversified portfolio and maximize returns?
I will, thank you for the question, Mr. Member Boychenko. So I will describe in a very summary fashion how we allocate investments and the process that surrounds the whole thing. So to contextualize, we have a set of policy targets and ranges that are agreed upon by each client. So our friends, we work very closely and collaboratively with our friends at the Treasury Board and Finance to establish the actual investment policy by which that we are going to abide by, with targets, specific targets for each asset class. And so once we've done the work of looking into the strategic asset allocation, so the very long-term asset mix for the Heritage Fund, as alongside the different targets for each asset class, then comes the time for implementation. And the most important thing that we look for with respect to implementation is whether or not AIMCO would, as the asset manager of the Heritage Fund, has a competitive edge. And let's pick on the example of infrastructure, for instance, here. So we try to match our competitive edge internally in terms of our portfolio managers that are managing the portfolio, as well as some of the objectives, the long-term objectives of the Heritage Fund. And one of the key characteristics of the Heritage Fund is its perpetual life. And we take that very seriously when we try to come up with the most appropriate set or asset mix for the fund. And so infrastructure, for example, is a great match for that long life characteristic of the Heritage Fund. And it has also some other benefits, such as it's difficult to replicate asset class. It has hard, or let's say large barriers to entry as well. And so some of those characteristics do provide a natural competitive edge for us to enter into on the behalf of the Heritage Fund. And of course, from time to time, we do take advantage of the fact that given the long life of the Heritage Fund, it means that the Heritage Fund can be patient. And often what we see, especially on the public market side, is that investors are somewhat impatient. And so we can take advantage of that on the private market side in such asset classes as infrastructure to make sure that we can invest for the long haul on the behalf of the Heritage Fund.
Can you please assure all members in this committee and Albertans that AIMCO makes these investments without any kind of political interference from the government of Alberta?
Absolutely. We make investments for our mandate, and that's our sole North Star.
Perfect. Thank you.
With that, any final questions from opposition? Please go ahead, Ms. Gray.
Thank you. In the quarterly report, I'm just looking on page 17, note 7 around investment expenses. And it appears in comparing 2023 to 2022, the investment expense as a percentage of dollar invested hasn't changed, but I'm noticing an increase in investment costs. And I just wondered if you can speak to what you're seeing in this quarterly report when it comes to investment expenses, if there's anything of note.
Sure, I can address that. Yeah, thank you for your question. So, as outlined here on page 17, note 7, so the investment expenses, there are really 4 categories of those investment expenses. So the first one is the Heritage Fund's share of AIMCO corporate operating costs. So these are salaries and benefits, technology, data costs that we use to run the investment platform. The second point is the performance compensation for AIMCO staff. Third one is external investment manager fees. And then the last of the four is the external investment management performance fees. So what you see is the largest variability in our investment expenses is really the performance-linked costs. So with respect to AIMCO performance costs, there's a large component based on our 4-year investment returns, both excess returns as well as total returns. And we provide quite a bit of disclosure on our investment performance compensation plan in our annual report. And we also have performance-based contracts in place with all of our external investment managers. So when they do well, our clients do well, so those contracts are very much aligned with our clients' best interests. And then most of the performance-linked costs are really from our external investment managers.
Follow up, Ms. Green?
Just when it comes to the external investment managers, is the amount of external investment managers something that remains constant? Are we doing more of the external, less?
It has grown a bit, year over year. It's up, I think, about $4 million, the investment management fees. And that's, I think, reflective of more investments in private equity asset class.
Mr. Bouchard.
Thank you, Chair. I'd like to hear more about the asset allocation listed on page 2. Since foreign equity accounts for a whopping 28.5% of the fund, I was hoping you could provide some details on what types of assets fall under this category.
So primarily on foreign equities, majority of what we hold in this bucket are shares of international entities, think Microsoft, think Apple, etc. Now, the benchmark that we manage this portfolio to is the MSCI All Country World Index. MSCI is one of the leading index providers, and this is a commonly used benchmark by many institutional investors. The benchmark has roughly 2,000 medium and large cap or large sized companies across the United States, Europe, UK, Japan, Canada, etc. So multiple countries. And then lastly, it's about currently 60% US, 6% Japan, 4% UK, 3% Canada. So that's the rough canvas in terms of where these investments are, just from a benchmark perspective. And needless to say, this is a very diversified exposure, 2,000 companies, though our portfolios hold a subset of the benchmark names. Secondly, in addition to what the investable universe looks like, we implement it in different manners internally. So we have a team that utilizes the fundamental investing approach, where they are undertaking a more traditional stock picking exercise. We also have a team that utilizes systematic investing, which is more quantitative and looks at a variety of factors in making those investments. And then thirdly, we also leverage external partnerships that allow us better access and leverage areas where we benefit from specialized expertise that our partners bring to bear. And we do that again using not only in a traditional equity space, but also hedge fund space, which allows some specialized investment activities that are accretive to the objective of the equity portfolio.
Thank you.
Mr. County.
I actually want to ask a little bit more about that, if you don't mind. Do you find, does the active management premium then take into account additional factor tilts? So you talked a little bit about benchmark and beta risk, but of course, in a long-lived portfolio, you can just take duration, right? And then that can look like alpha over enough time. Can you talk a little bit about that? Like, do you adjust the active management premium for those kinds of factor tilts, or do you manage those factor tilts actively and change them over time?
Yeah, so we do manage that actively over time. By the way, that's a great question, and quite exciting. But we're gonna stick away from the details and stick to the high level. So typically, where you would find is, and where the misclassification is in those types of portfolios, if you see a manager with a perpetual tilt, so to use your fixed income example, if you have a perpetual credit tilt, is it alpha, or is it just simply excess return? That's debatable. In the equity space, that example doesn't transfer over that directly. So for example, one of the popular trades a few years ago was being tilting or leaning more heavily into low volatility stocks, so the boring stocks, and then there was a premium. So it was good for a few years, but it wasn't in the last couple of years, and likewise the value type trades have been hurting for many years. So in summary, that is something that we look at actively, we manage it actively, and particularly the systematic team looks at that in an ongoing manner.
So how does that relate then to your active management premium? Like, does that right now? Because you can, like, I don't have I guess, like, if I were to evaluate a book, right, like, it doesn't, it's fine to say, okay, you know what, like, we've got an oil price factor, for example, because we're invested in TSX and oil price, and that's highly interest rate sensitive and oil price sensitive. And then over time you can, like, change those tilts, and that is like active management, if you will. Or you can just hold them, in which case it's, as you say, it could just be, uncompensated risk that is in fact just working out for you. Does that enter into your active management premium, or is the active management premium like quite different from that?
So it's a two-part answer. So the heritage portfolio. So for example, and I'll use a simple example, to the extent that it is invested using an MSCI World benchmark. So as soon as you make that assertion, because the MSCI World is large cap and mid cap, in effect you're saying that's an attractive, call it factor, call it beta exposure over time. So that's built in terms of how the portfolio is designed, and the thesis is that policy mix ultimately is aligned with the overall objectives of the heritage fund. So that's the first part that is already inbuilt, if you will, before even you get started. The second part is as you look at the portfolio when it is getting implemented, and the positions and the tilts, if you will, that we have. That is something that changes over time, and that's where the active process kicks in relative to the tilt that is more perpetual.
Thank you.
And with that, this concludes our discussion of the report. Now the committee must consider a motion to receive the first quarterly report. The committee clerk has posted some wording for a potential motion. Well, is posting some wording for a potential motion on the screen in the room and on the video conference. Can I have somebody move this motion? Mr. Boychenko.
I move that the stand committee on the Alberta Heritage Saving Trust Funds receive the Alberta Heritage Saving Trust Fund 2023-24 first quarter report as distributed.
Is there any discussion on this matter? All in favor, please say aye.
Aye.
All opposed? Carried. With that, the motion is carried. I'd like to thank our guests from the Treasury Board and Finance, AIMCO, and the Office of the Auditor General for being here today. We'll be moving on to deal with some other committee business. You're welcome to remain, but we understand if you have some other engagements. Thank you guys so much.
Thank you.
Thank you.
It's nice to meet you all too.
So at this time, traditionally, we might ask for a 5-minute break. But that said, the final order of business is just deciding on an annual public meeting. And I have asked, and we could be done very, very quickly if you so choose to forego a meeting or a break. And with that, we need to decide on a location, date, and format. In accordance with the Alberta Heritage Savings Trust Fund Act, the committee must hold public meetings to inform Albertans about the status of the fund. The public is encouraged to participate in these annual meetings by attending in person, phoning in, or submitting questions online through email or social media. The committee previously held the annual meetings in locations around the province to encourage public engagement. However, with advancements in communication technology, the meeting has been held exclusively at Edmonton venue since 2011. Starting in 2015, the public meeting has been held in committee rooms on the second floor here in the QE2 building. We all have the broadcasting and technological equipment needed to broadcast on TV and live stream the meeting on the Assembly website. Although the committee is not required to hold a public meeting in our committee rooms, previous committees have found this to be the most practical and cost-effective solution. As it is already November and we have limited time to plan this meeting, I'd suggest that the committee follow what's become the status quo and have the meeting here in the Queen Elizabeth II building again. Before we discuss setting the date, do any members have any questions or comments about holding the public meeting here in our committee rooms? Seeing none, we now turn to the date, time, and format of the meeting. The public meeting is usually held in October, right before the start of the fall sitting of the Assembly. The meeting, which is usually scheduled for 2 hours, has typically been held on a Thursday evening outside of traditional work day hours to allow the public to attend and to ensure that the Assembly will not be sitting. The most recent meetings have allowed public participation in person, via telephone, or by submitting questions through a web form on the committee's website, by email, or using the Assembly's social media channels. With this in mind, I did ask the committee clerk for their suggestions on a date and time to meet, and it was suggested that in order to give LAO Communications sufficient time to advertise the meeting and allow for that public interaction, that the committee may want to consider having this year's public meeting on Thursday, November 30th, 2023, from 6 to 8 p.m. Do members have any questions or comments about this date and time of Thursday, November 30th, from 6 to 8 p.m.?
Oh, right, so alleged doesn't seem.
Please, Ms. Gray.
Thanks so much, Mr. Chair. So we're just looking at Thursday, November 30th in the evening. We're wondering if there were any other dates that were up for consideration or just the single one.
Again, that was just a suggestion by the committee clerk, but he also suggested we could possibly do the following Thursday at the same time if you feel that we need more time.
Are we considering Thursdays because we're concerned there could be an evening sitting and the
Yes.
implication there?
Yeah.
Okay, so that's
You are a house leader, you
No, that's understandable, and we don't always know when an evening sitting is going to happen. So the committee clerk is suggesting November 30th or potentially December 7th.
Yes.
If we push that back a week. So we're just considering that. Give me one moment, Mr. Chair.
Absolutely. I ask you to consider family-friendly legislature as you guys had in 2015. So, with that, we will put a draft motion on the screen for all to consider, and I'm asking for someone to proceed with pitching that motion.
I'll do it, yeah.
Mr. Bouchard?
Sure.
Yeah.
Okay. That the Standing Committee on the Alberta Heritage Savings Trust Fund schedule its 2023 annual public meeting for Thursday, November 30th, 2023, from 6 to 8 p.m. at the Queen Elizabeth II building.
Perfect. And with that, any further discussion on that? Can I ask who's all in favor of this scheduled date?
Aye.
All opposed? And with that, that motion is carried. And so for the benefit of all members, but particularly our new members, I will attempt to describe the standard format for the public meeting. These meetings are intended for the public to learn and ask questions about the Alberta Heritage Savings Fund. The format that is followed begins with the Treasury Board of Finance and AMCO, each making a presentation on the fund. Following the presentations, the meeting is opened up for questions from members of the public. The chair alternates between taking questions from those in the room, on the phone, and from online sources. Unlike a regular committee meeting, Members will not typically be asking questions unless there is a lull in questions from the public during the meeting. So I'd ask that you please prepare some questions, but understand that we may not get to them. Are there any questions about the public meeting format before we move on to the communications plan? Mr. Kozlowski.
Thank you, Mr. Chair. It's probably related to communications, but in terms of attendance, online and in person, what is the typical attendance in numbers?
I can handle that, Mr. Chair.
Please.
Thank you, Mr. Chair. It really varies year to year. In last year, we had one person in person attending the meeting and 3 people phoning in. The year before that, the gallery was closed, so there was nobody in person. And then the prior year to that, I think they had 6 or 7 in person and 2 on the phone lines. It really varies, but it's not a huge number of people in person, generally speaking. But yeah, it really varies year to year.
Yeah, so did you follow? So in preparation for the annual public meeting, the normal practice is for the committee to meet with LAO Communications Service staff well in advance of the public meeting to discuss advertising for the meeting. The committee then directs LAO to prepare a communications plan, which will be reviewed and approved at a later meeting and then implemented in the months leading up to the public meeting. However, this year, due to the time constraints we face, LAO Communications Services staff have prepared a proposed plan, which was made available to committee members on the committee's internal site last week for review today. At this time, I'd invite staff from LAO Communications Services to discuss a proposed communications plan and how it supports a public meeting, and then committee members will have the opportunity to ask questions. So with that, LA Comms, the floor is yours.
Thank you, Mr. Chair. I won't get into a lot of detail. As the chair explained, we are looking at a plan very similar to last year, simply because of the timelines, which would allow us a lot of time to do, or enough time to do the advertising, should this committee choose to go with that. Just a little bit further to the question you were asking earlier about attendance, there was a report submitted to the previous committee that outlined exactly who heard of our meeting how and how many people participated in different ways, which I would be happy to make available to this committee. I think our live stream viewers at a height were about 36, so you get people coming in and out throughout the meeting. So we look at not only making people aware that the meeting is happening, but also trying to engage them to learn more about what this committee does and what the Heritage Fund does. Towards that end, we're recommending a number of strategies that were implemented last year, including a way to support remote participation by doing social media advertising, province-wide advertising, and we're suggesting, again, through both daily and weekly publications. The daily publications, there's 7 throughout Alberta. The weekly publications varies from from time to time, but it gets into the smaller community newspapers, and it's about 80 to 85 publications right now, I think. And then again, we would do some no-cost options. So you've got the website, you've got media relations, an e-card. We do a media kit for members so that they can engage their own constituents within their communities. We also, of course, use a lot of social media organic posts to promote through X, formerly known as Twitter, Facebook, let people know about the phone and email options. We also use social media to leverage educational information about the fund. And I think that's about it. We then again, what I was just alluding to, measure the results of all of the different initiatives and share that with the committee at the end so that they know how people are learning about the fund, and that helps direct how we would recommend future initiatives. This year's a little bit different because there's not a lot of time between the time the committee was struck and the time that the public meeting is held, so that's why we were relying heavily on pretty much what we did last year. And with that, Mr. Chair, I would open it up to any questions.
Thank you so much for that. We'll now open the floor to discussion from any of the members if they have any questions.
Just a quick question.
Yeah, go ahead.
We're free to put it on our own social media?
Absolutely. In fact, if I may, Mr. Chair, part of what we would do would be to draft like an e-card for you, some social media posts, provide that to all members so that we have consistent messaging going out. And that would be well in advance of the meeting. We try, probably within the next week, we'll be putting all the materials together and then starting to promote to give a week or two notice to Albertans.
Would be nice if everyone definitely advertised it. Out of those 36 that were online, how many of those were staff?
I will not comment on that, Mr. Chair.
With that, please.
Yeah, Mr. Chair, just, I look at that 39,000 and the attendance that you yield, and I know that now we're talking about 3 weeks from now, so how much does a direct mailer cost to everybody in Alberta?
So direct mailers, I believe we actually looked at that for this year, but we would have to build it from scratch, which we didn't know that there'd be time to do this year. I think it was coming in around $4,000 or $5,000 to do just. Sorry, no, to let me clarify, that was just to do the Edmonton, like the area close to this building, that didn't include a province-wide mailer. And I don't wanna say what that would be, I know we did one for a campaign a few years ago, but I don't have the numbers in front of me to provide enough clarity to this community.
Do you have a follow-up, sir?
I mean, I just mostly discussion, Mr. Chair, I just am trying to like, envision the best way it's a $39,000 budget is a significant amount of money to attract people here for such a low turnout.
Mm-hmm.
I get that there's a point of like, maybe for a moment someone sees it and goes, oh, Heritage Savings Trust Fund, good, or whatever that is. And so I'm just wondering, I guess the question, if we were to move away from print ads, is there something more effective we could do in terms of raising awareness about the trust fund in the community?
If I may, Mr. Chair, certainly there's any number of options that we can do. Social media is definitely where we get most of our, I guess, our interest or awareness about the meeting. The newspaper print tends to target an older demographic and probably more of the communities in the rural areas than the social media, but we can always upgrade that, maybe pull the weeklies out, do the dailies. There's so many options. I think what we're stuck with now is just trying not to do a whole lot of new initiatives because there's simply no time to put those together. If there were, certainly the mailer would have been an idea that we would have pursued. In fact, it was in there until we found out that the meeting was happening so soon.
No further questions.
Perfect. With that, if there are no further questions, the committee should now consider a motion to approve the communications plan. So, sure as can be, a draft motion to approve the communications plan as distributed will be put up on the screen for someone to consider. Oh, look at that. Does Mr. Weed?
It's been moved that the standing committee on the Alberta Heritage Savings Trust Fund approve the draft communications plan in support of the 2023 public meeting as distributed.
And with that, do I have any further discussion on this matter? And with that, we will vote. All in favor of, please say aye.
Aye.
All opposed? Thank you so much. That motion is carried. And that said, we can also look, we can discuss behind the scenes further communications plans for future meetings, absolutely. If we want a bit more robust to try to incentivize people to actually watch us, that'd be fantastic. Now that the committee has decided to amend the proposed communications plan, LEO Communications will revise the plan as quickly as possible and provide it to the committee for approval. Given the aforementioned time constraints and to allow for sufficient advertising. Oh, sorry, my apologies, we're not amending the plan, so, that's it then, just other business. So with that, are there any other issues for discussion at today's meeting? Nothing, so with that, our date of our next meeting will be our public meeting on Thursday, November 30th, 2023 at 6 to 8 p.m. in the evening. So look forward to seeing all of our members there. Thank you all so much, and everyone have a wonderful day. Oh wait, a motion to adjourn, of course. I can't get off that easy, can I? If there is nothing else for consideration, I will call for a motion to adjourn. Mr. Rosewell? Yes, all in favor of adjourning the meeting?
Aye.
All opposed? With that, I just want to say this was the most pleasant committee meeting I've ever been in, so thank you everybody so much for that.
Thank you, Mr. Chair.
All right, this meeting is adjourned.